Uniqueness of MCX options, options on futures.
I was wondering what makes MCX options different.
One significant and distinguishable aspect of pricing options contracts for the commodity market segment is that most of the options contracts traded in commodities are options on futures. This means that the underlying is the futures contract of the commodity traded in an exchange. In the equities segment, the underlying in the options contract is the stock that is traded in the cash market segment and not the futures segment.
What are the reasons for this?
There are several reasons for this. Commodity risk is mainly in the futures market. The real risk that commodity producers, consumers and traders face is usually in the futures market, not the spot market.
Can we discuss this with an example?
Sure. Think about a jeweler. Suppose a jeweler is worried that gold prices might rise over the next 3 months. They could buy gold futures and lock in a price, but this creates an obligation. Buy a gold put option on gold futures. This limits downside risk to the premium while preserving upside.
So, the option is simply giving them a more flexible way to hedge their futures exposure.
Exactly. Now you are getting it. Historical reason.
Is there any historical reason as well?
Commodity exchanges had futures much before they had options. When exchanges later introduced options, it was far easier to build them on top of the existing futures infrastructure rather than create a completely new physical settlement option framework. Commodity exchanges created options on futures because futures contracts were already standard, liquid and deliverable instruments used for hedging commodities. Futures are already the benchmark price.
Apart from history and risk management, is there any other reason why MCX options are based on futures?
Yes, in commodities, the futures market is often more important than the spot market. For example, gold traders watch gold futures. Crude traders watch crude oil futures. Copper traders watch copper futures. Those futures prices are what producers, consumers, refiners, importers and exporters actually hedge against. So, it makes sense for options to reference futures.
Okay, I got it.
Devolvement of commodity options into commodity futures.
What is devolvement of commodity options into commodity futures?
We already know that the underlying to the commodity options contract is the futures contract of the commodity traded on the exchange. Commodity options contract offer the market participants a unique set of risk management and investment opportunities. The options call buyer obtains the right to buy or go long in a specific underlying futures contract, while a put buyer gains the right to sell or go short on the underlying futures contract. These options contracts expire a few days prior to the expiry of the futures contract. On expiry, these options contracts get devolved into the corresponding futures contracts and then get settled as per futures contract settlement methodology.
What options does the buyer have in case of devolvement?
The buyer can either opt to square off after devolvement and settle in cash, or let the devolved futures position get into the delivery period if he or she desires a delivery. Summary. Just to summarize, most of the options contracts traded on commodities world over are options on futures. All options contracts traded on MCX are options on futures. A commodity option ultimately references a futures contract because futures are the primary hedging instrument, futures already handle delivery and standardization, futures are already the benchmark price among market participants. Exchanges can manage risk more efficiently.